We think diversification is, as practiced generally, makes very little sense for anyone that knows what they're doing.
Quote me. 90 for 3,000. 90 for 3,000, fill or kill.
This is a funny business. You don't have to be right even 5 times out of 10. If the times you're right, you make a double and triple. It offsets all those times you lose 20 or 30%.
If you are successful as an investor, you are going to end up with 80% in a single position.
He would look for investments where he didn't want to invest unless he believed if he invested $1, he could ultimately make 5 off that dollar.
If everyone spent 9% of their time on math, rather than 9% of their time on pie in the sky ideas about how much money they're going to make, then it'd be incredibly successful investors.
Some of them thought you were crazy. Some of them probably thought you lost your mind.
I know for sure that some of them thought I lost my mind.
I am going to show you 3 strategies that can help you beat the market in this video. Now, everybody wants to beat the market, right? But let's be honest, most people don't. In fact, most professionals don't either. But why is it so hard? Why do smart people with fancy degrees and research teams still underperform the market? And what can we do differently in order to put the odds in our favor? That is what we are going to go over in this video. Now, before we start, I want to give you a little bit of a bonus tip on beating the market. And it has nothing to do with the stock market, but rather building your own business. Because making money with your own business can beat the market tenfold. But Alex, I don't have any business ideas to start. Don't worry, I got you. I started a free business newsletter where I give you 3 business ideas every week that you can start right away. Now, the idea is to make money in your business and then invest that money to grow it even more. This is what I've done with my business in the magic and playing card industry. So if you want to start your own business or you want to grow an existing one, go ahead, sign up to my newsletter. It is free and it always will be. So go ahead, start stealing some of my ideas today. Sign up with the link in the description. I'll wait. All right, first thing is first, we need to talk about why most people don't beat the market. And I'm including professionals in this. Understanding this first and foremost will give us a better understanding of what it really means to beat the market and give us a framework to work with. Let's start with the benchmark, the S&P 500. Now, the S&P 500, which is the most common index, has returned on average about 10% per year over the long run. Now, this is not guaranteed every year, right? Some years it crashes, other years it booms, but across decades, 10% is the ballpark, right? So if you are trying to beat the market, that is your bar to reach. That's what you would need to outperform consistently. But remember what I said earlier, most professional fund managers, right, the people who do this full time with research teams and Bloomberg terminals, they still underperform the market. And that is after fees, because even if a manager does beat the market before fees, the 1 to 2% they charge can eat up those gains. So the average investor like you and I might look at this and say, well, if the professionals can't do it, what chance do I have? And that's a fair question. Now, one big reason why it's so hard comes down to something called the efficient market hypothesis. The idea is as follows. All publicly available information is already priced into stocks, right? If Apple is releasing a new iPhone, well, that's priced in. If the Fed is cutting rates, well, probably priced in, right? If there is a war, inflation, GDP print, earnings beat, all of that gets factored in and reflected in the price almost instantly. So unless you know something that no one else does, it is hard to have an edge. But even if somehow you do have an edge, there's another problem. Well, you, me, and everybody else, because we are all human and humans have emotions. We all make terrible decisions at the worst times. See, most individual investors are the market. We all hold the same index funds, the same ETFs. We panic sell when things drop, we buy high and sell low. And by my calculation, that's the exact opposite of what we should be doing. But we do it anyway. In fact, studies have shown that the average investor earns way less than the market returns simply because of bad timing. Then there is the day trading trap, right? Those short-term gains that everybody loves. People see YouTube videos of traders making thousands of dollars in a day and think that, hey, that could be me. That's what they say, right? That's what you say. I know I've said that on possibly a few occasions. But deep down, we all know the truth, right? Most day traders lose money. Why? Because short-term price movements are mostly noise. Hopes and dreams don't beat the market, and that's what mostly day trading is, unfortunately. And finally, there is the no research crowd, right? The people who get their stock tips from Reddit and TikTok, possibly YouTube, or from their cousin at Thanksgiving. And by the time that they buy in, the move is already over. Now remember this, if everybody knows it's a hot stock, well then it's probably not anymore, right? The edge is gone. So yeah, beating the market is hard if you get wrapped up in the dollar cost averaging, emotional investing, things like that. But here's the twist. It's not impossible. In fact, some of the greatest investors in history have consistently outperformed for decades. They used specific strategies, which is exactly what we are going to learn and apply. Most people think of Warren Buffett as a boring buy and hold investor. In fact, a lot of his public advice is to dollar cost average into an index fund and hold that for a long period of time.
I think it's the same thing that makes most sense practically all of the time, and that is to consistently buy an S&P 500 low-cost index fund. Keep buying it through thick and thin, and especially through thin.
But he himself hasn't taken that advice. Have you, Warren? The truth is that Warren Buffett made most of his fortune taking concentrated bets, meaning he is willing to put a large percentage of his portfolio into a few businesses when the odds are overwhelmingly in his favor. For example, at various times, over 40% of Berkshire's equity portfolio has been in a single stock. This approach comes from Warren's belief that diversification is protection against ignorance.
We like to put a lot of money in things that we feel strongly about. And that gets back to the diversification question. We think diversification is, as practiced generally, makes very little sense for anyone that knows what they're doing. Diversification is a protection against ignorance. I mean, if you want to make sure that nothing bad happens to you relative to the market, you own everything. There's nothing wrong with that. I mean, that is a perfectly sound approach for somebody who does not feel they know how to analyze businesses. If you know how to analyze businesses and value businesses, it's crazy to own 50 stocks or 40 stocks or 30 stocks probably, because there aren't that many wonderful businesses that are understandable to a single human being in all likelihood, and to have some super wonderful business and then put money in number 30 or 35 on your list of attractiveness and forego putting more money into number 1 just strikes Charlie and me as madness.
If you truly understand a business, spreading your bets too thin can actually dilute your returns. A perfect example of this is Coca-Cola, which Warren Buffett began buying in 1988 after the market crash. At the time, he poured over $1 billion, roughly a third of Berkshire's entire stock portfolio, into the company. Over the next couple of decades, that position grew to over $20 billion. That is a 20x return on a huge concentrated bet.
It's a little crazy. They've been selling Coke since 1886. They sold 1.9 billion 8-ounce servings a day. That's 693 billion servings a year of Coca-Cola products, one kind or another. 20 years from now, there will be more people. There will be more Coca-Cola cases consumed than there are now by some margin. Back in the late 1930s, Fortune ran an article saying that the growth of Coca-Cola was all over. And when we bought our Coca-Cola stock in 1988, people were not that enthused about gross profitabilities for the product.
More recently, Apple has followed a similar pattern. Buffett started buying Apple in 2016 and built it into over 40% of Berkshire's equity portfolio.
I bought another 123 million shares or something like that.
Why?
Because I liked it.
At one point, Berkshire's stake in Apple had grown from around $36 billion in cost to well over $160 billion of market value. These weren't tiny diversified positions, right? They were dominant allocations, showing Buffett's belief that when you find an exceptional business, it is better to own a lot of it than a little. Peter Lynch didn't need Wall Street suits or Bloomberg terminals to beat the market. He just needed a trip to the mall and a curious mind. As the manager of the Fidelity Magellan Fund from 1977 to 1990, Peter Lynch delivered an average annual return of 29%, more than doubling the market and turning that fund into the best performing mutual fund in the world. How? Well, not by timing the market or betting on macro trends, but by doing something far more practical, investing in what he knew and doing the research that most people wouldn't bother with.
The single most important thing to me in the stock market for anyone is to know what you own. I'm amazed how many people own stocks. They would not be able to tell you why they own it. They couldn't say in a minute or less why they own it. Actually, if you really press them down, they'd say the reason I own this is the sucker's going up. I mean, that's the only reason. That's the only reason they own it. And if you can't explain, I'm serious, you can't explain to a 10-year-old in 2 minutes or less why you own a stock, you shouldn't own it. And that's true, I think, about 80% of people that own stocks.
Lynch's philosophy was simple but powerful. Invest in what you understand. He believed that the average person had a real edge by simply paying attention to the world around them. The stores they shopped at, the products they loved, the trends they spotted before Wall Street caught on. But that was just step one. The real magic came from his deep boots-on-the-ground research. He would actually go visit stores, right? Talk to employees and dig through annual reports, all to find companies that were growing fast, still under the radar, and undervalued.
So you see a company, I did really well with Dunkin' Donuts, a local company. I did well with Stop and Shop. But people could see that these are really some people showing up, or I guess the Sunglass Hut, no one's there anymore. So I mean, that's research. That's fundamentals. So you don't leave the mall, though, and buy that day. You have to do some more work.
Lynch famously hunted for what is called 10 baggers, stocks that could return 10x or more.
It's funny, in a stock, all you can lose is 100%. I've done that. And your great mistakes is selling a good company, and then it doubles, then it triples, and quadruples, because you make a lot of mistakes. And so it's ones that go up tenfold. I call them the 10 baggers. So some of my mistakes are just saying, oh my God, this stock is too high, and I was wrong. And you had to figure out, what inning am I in this baseball game? I sold Toys R Us way too early. It went up 20-fold after I sold it. I did the same thing at Home Depot. Those are probably my two greatest mistakes I ever made.
One of his best-known 10 baggers was Dunkin' Donuts. He noticed it not through a complex screen or analyst report, but by observing how people lined up at Dunkin' Donuts every morning. Pretty simple. Now, that simple insight led to deeper research where he discovered that the company had a strong brand, simple business model, consistent growth, and room to expand. Lynch invested in the company before it became a household name, and over time, Dunkin' Donuts returned more than 10x his initial investment.
This is a funny business. You don't have to be right even 5 times out of 10. If the times you're right, you make a double and triple. It offsets all those times you lose 20 or 30%. So when you buy a stock, you got to say to yourself, how much can I lose and how much can I make? And you ought to be able to make a lot.
He believed in owning many good ideas because even if some failed, those 10 baggers would more than make up for the rest. Most people try to outsmart the market by being original, but Monish Pabrai took a different route. He built his fortune by shamelessly cloning the world's best investors, especially Warren Buffett. In fact, Pabrai has said repeatedly, "I'm not looking for new ideas. I am looking for good ideas that others have already validated."
I couldn't do what I do as an investor if I didn't have cloning as part of the DNA. I think it's one of the most important models for investing. I still don't know why, but humans in general have an aversion to cloning. They mostly think it's beneath them, or they think it's something like cheating in some way. I could not come up with these ideas on my own. I came up with this idea from Warren and Charlie, and I copied it. So one of the most important models that you can adopt is the model of cloning. When you see someone doing something smart, just incorporate it. That's a good way to go.
But don't mistake cloning for laziness. Pabrai runs a concentrated portfolio and waits patiently, sometimes for years, to strike when the odds are clearly in his favor. He focuses on high-quality businesses trading at a discount, and when he finds one, he is not afraid to make it a big part of his portfolio.
Well, when you make a bet, we ideally want it to be a 10% bet, right? So in an ideal world, if I'm starting out on day one and I had 10 ideas, it'd be 10% each, right? Now, what happens is that when we buy something at 2% liquidation value in Turkey, like we did, and goes up, it's going to become like, 40, 50% of the portfolio. And we're not going to trim that because it's still undervalued. So basically, if you are successful as an investor, you are going to end up with 80% in a single position.
One of his best known bets was in India's auto finance company called Shriram Transport, which he bought in the early 2000s for just $1 per share after seeing that it had a dominant position in lending to truck drivers, a niche market with little competition but huge demand. He invested over 10% of his fund into it, and within a few years, the stock had 20x'd, turning a $10 million investment into $200 million. Now, just like Buffett, Pabrai avoids diversification for its own sake. He believes in making very few high-conviction bets, and then sitting on them for as long as is needed.
So I would say for the mere mortals like us, not the mongers of the world, I think if you got to probably something like 10 stocks that you understood really well in a few different industries, that's plenty. I don't think you should get to 50 stocks in a portfolio. I think that's not going to help you. But something like 10, 15, or 8 or something is probably a good number.
His approach shows you that you don't need to be a genius to beat the market. No offense to him. You just need the humility to copy, the patience to wait, and the courage to go big when the odds are in your favor. Paul Tudor Jones built his fortune by being a contrarian at heart. When the crowd rushes in, he steps back. When everybody is complacent, he gets cautious. And when fear is everywhere, well, that is often when he strikes.
Quote me, quote me, quote me. 90 for 3,000. 90 for 3,000, fill or kill.
His core philosophy is built around one simple idea. Look for asymmetric bets. Situations where you risk $1 to make $5, $10, or even more. And then cut your losses quickly if the trade goes against you.
I was hired to come in. I uncovered for Paul Tudor what he was doing at his best. I got to interview all the people around him. I watched films. There were patterns that Paul Tudor was doing when he was at his very best, and he dropped them out. One of those things that I learned from him, he risks for asymmetrical returns. Asymmetrical risk reward means they try to do the least amount of risk possible with the most upside. He would look for investments where he didn't want to invest unless he believed if he invested $1, he could ultimately make 5 off that dollar, 5 to 1. Now, he knows he's going to be wrong lots of times. And so he knows if I risk $1 and I lose, I can risk another $1, I'm still going to be up 3, you follow? He could be wrong 4 times out of 5 and break even still. So that's the secret.
He once said, "I am always thinking about losing money as opposed to making money. The most important rule of trading is to play great defense."
That's why most people lose money as individual investors or as traders, because of the fact they're not focusing on losing money. They need to focus on the money that they have at risk. How much capital is at risk in any single investment they have? If everyone spent 9% of their time on that, rather than 9% of their time on pie in the sky ideas about how much money they're going to make, then they'd be incredibly successful investors.
One of his most legendary contrarian asymmetric trades was during the 1987 stock market crash, the month I was born. While most investors were blindsided, Jones saw the signs. He took a massive short position using futures and options, betting that the collapse was imminent. Now, when the stock market did crash on the famous Black Monday and the Dow Jones dropped by over 20%, Paul Tudor Jones made a killing and made over 60% that year for his fund, while most other investors were wiped out. Now, that trade wasn't necessarily about perfect timing. It was more about positioning. Small downside, massive upside, right? He built a career on that principle. It's not about being right all the time. It is making sure that when you are right, it really counts. And when you are wrong, you live to fight another day. Most people invest by following trends. Whatever's in the headlines, whatever Wall Street is hyping. But Michael Burry made his name and his fortune by doing the opposite. He is the definition of a contrarian. He is not afraid to bet against the crowd, even when it looks crazy on the surface. His portfolio is known for being highly concentrated, sometimes with only a handful of stocks, and it's constantly shifting because, well, the facts are always changing in this world of investing. So when the facts change, so does he. His most famous move, of course, was shorting the US housing market in the early 2000s. While everybody else thought that real estate could only go up, Burry actually analyzed mortgage data and realized that the whole system was about to collapse.
Short 8.4 billion of credit default swaps related to mortgages or financial companies.
You must have been pretty confident that this thing was going to blow
Well,
up.
we had a giant bet for us, and I was extremely confident in the outcome.
He used credit default swaps, which are basically, in very simple terms, custom-built options to profit if subprime loans collapsed. The trade had massive upside if he was right, and he wasn't afraid to go in with a large size position, so his reward for this investment would outweigh the risk of being wrong. That is the kind of asymmetric bet that he loves.
I think if you just pay attention, you'll get a warning sign. Heck, you know, when I figured out the subprime thing, I had to do it off human behavior and various sources of witchcraft wizardry in 05. By early 06, it was apparent in the actual filings that were being made every month. And you just had to look at that, and it was really easy.
Even in recent years, his 13F filings show concentrated bets, like going heavy into companies like GameStop before the mania, or using put options to hedge against market crashes. Burry's approach shows that to truly beat the market, you have to be willing to look crazy now to possibly look brilliant later.
Some of them thought you were crazy. Some of them probably thought you'd lost your mind.
I know for sure that some of them thought I lost my mind.
Now, if we break down the strategies of these investors, you'll start to notice that they all follow certain themes that help them beat the market. So now our job is to analyze these strategies step by step so that we can understand them and apply them to our investing, which is what we are going to do right now. Let's start with one of the boldest ideas in investing: concentration over diversification. Now, this goes against everything most of us are taught. We are told to spread our money across dozens, sometimes hundreds of investments. That way, if one goes wrong, well, then it won't hurt you too much. But here is the problem with that. When you diversify that much, you are also limiting your upside. Your winners get diluted by the average of all your bets. So here's where concentrated investments flip that idea on its head. So if you think that you have an edge, whether it's through research or conviction level or just convenient timing, then putting more money into your best ideas can generate far better returns than spreading your capital thin. Let's bring back Warren Buffett for a second. Over 40% of Berkshire Hathaway's equity portfolio is Apple. That is one company out of thousands that he could invest in. I remember reading something that Warren Buffett said a long time ago, and it stuck with me. Imagine making a list of the 10 best investments that you can make, right? And list them out from number 1 to number 10. Now, the question is, why would you put money in number 10 or 9 or 8 when you can put more money into the best ideas, number 1, 2, 3? Now, Buffett isn't alone in this thinking. Stanley Druckenmiller, another legendary investor, is known for saying, "I've learned that putting 10% of your portfolio into your best idea is not aggressive. It's negligent if you believe in it." This is what great investors do. They wait patiently, they build conviction, then they go big. Now let's put some numbers to this. According to studies by JP Morgan and Vanguard, just 4% of all publicly traded stocks are responsible for 100% of the net gains in the market over the long term. This means that if you randomly owned 100 stocks, statistically speaking, most of them would either break even or lose money. Only a few are pulling all the weight. So if you could find those few winners early, well, the strategy here is to go in with size. So let's say a few years ago in 2020, you created an equally weighted portfolio of just 5 companies, very concentrated: Meta, Apple, Google, Tesla, and Microsoft. Now, these are all large cap, well-known tech names. Now, over these 5 years, that small portfolio would have returned you 204%. That is more than double the S&P 500's 91% return in the same period. And these aren't random penny stocks, right? They are some of the largest companies in the world. But by concentrating into high conviction winners, you are amplifying your returns. Now, is it risky? Well, some might say yes. Concentrated portfolios always are with increased risk. But here is the nuance. Risk doesn't come from the volatility alone. It comes from not knowing what you own. So what this means is that the risk isn't necessarily in the fact that your portfolio is concentrated. It is in the fact that you might not understand your investment enough in order to have that conviction. So that's why it's obviously important to understand first and foremost what you own, have that conviction, and then make the investment. But that is obviously hard to do when you have thousands of companies to choose from. But here's where it gets interesting. I'll give you an example, and this is something to think about when thinking about your own capital allocation. Can you, right now, make a concentrated investment into something that has already beat the market consistently? I asked myself that question, then I took a look at none other than Berkshire Hathaway stock. Now, Berkshire Hathaway is a company that owns many other businesses, but it is a concentrated bet in disguise. You're not just investing in those businesses, you are investing in Buffett's capital allocation skills. You are concentrating your trust in one manager, not in 500 separate companies like you would in the S&P 500. And remember what I said about understanding your investment? But when you pick individual stocks, you need to understand them all. When I go ahead and I buy Berkshire Hathaway stock, I understand that Warren Buffett understands it. Now, this is just one example of how you can go about concentrating your portfolio by limiting the risk. And remember what Monish Pabrai said, why try to invest yourself when you can just clone your way to profit? Now let's talk about one of the most powerful yet misunderstood strategies in investing, and that is asymmetric bets. Now, an asymmetric bet is where the potential reward is much larger than the risk you are taking on. You are risking a small known amount of downside in exchange for a much larger, sometimes unlimited upside. Now, these kind of bets don't need to work all the time. They just need to work once in a while because the payoff when they do work is so outsized that it covers the losses of every other bet that didn't work out. So let me walk you through a few examples. Let's say you are bullish on a company, right? You believe in the fundamentals, the management, all of that good stuff. Now, instead of just buying the stock outright, you decide to buy long-dated call options, which are called leaps. So let's say you spend $1,000 on that option. Well, that is your maximum risk. You cannot lose more than that because you are buying options. And when you're buying options, the most you could lose is how much you paid to buy that option contract. Now, if the stock doubles in the next year or two, your leap options could 5x or 10x. So let's say that you took 10% of your portfolio and allocated it into these kind of leaps. Now, some might say that's a risky move, but if that 10% of your portfolio 10x's, you've essentially doubled your entire portfolio, all with a 10% risk. That is the essence of an asymmetric bet. Small downside, massive upside. Now, this is actually how professionals operate, right? For example, Stanley Druckenmiller, I bring up again, has openly talked about these asymmetric bets when macro conditions aligned. He would risk 1 to 2% of his capital for the chance to make 10 to 20%. Now, Buffett has done it too. People don't think of him as an options guy, but during the 2008 market crash, for example, he sold puts on the S&P 500 at prices so high that it was almost guaranteed money. So the downside was actually capped and he got his premium in return, which effectively added to his profits, which all snowballed into him beating the market, or at least helped. In fact, one of my favorite option stories is the one that inspired me to get into options in the first place, and that is the story of Cornwall Capital, which is depicted in the movie The Big Short as the Brownfield Fund. So long story short, Capital One stock at that time had crashed 50%, and these guys made an asymmetric bet that the stock will rebound in 2 years' time, so they took $26,000 from their portfolio and bought out of the money call options with an expiration date of 2 years out. And sure enough, the stock recovered, doubling in that time period. But instead of just making double their money, they turned their $26,000 into over $500,000. All right, so these are asymmetric trades with controlled risk. Now, another asymmetric setup is during a market crash or a specific company panic. Now, let's go back to Facebook stock in 2022. The company dropped more than 70% in less than a year. There were headlines saying Facebook was finished at the time. Zuckerberg himself was mocked for his metaverse bet, but fundamentally Meta was still a money-making machine. In fact, nothing really changed fundamentally with the company. It still had billions of users, high margins, strong cash flow, and was the #1 place that people would go to advertise. So if you understood the business and believed it would rebound more likely than not, you could have bought that stock for $90. 18 months later, it was back over $300. That is a 3x return. Now, what was the downside? Well, another 10 to 20% drop if things got worse. So there is another asymmetric bet. Risk one, maybe lose 20 cents of that dollar, but potentially make $2 or $3. And that is just with the stock itself. Imagine with Leap's options, how much more the upside would have been. Now, I've talked about this before, but my own personal experience with these types of asymmetric bets was during the pandemic crash of 2020. I basically saw that the market had crashed 50%, stocks were going down 60, 70, 80% at that time, and I bought Leap's options with an expiration date of 2 years out that those stocks will recover by that time. Sure enough, they recovered. I made 10x my money while risking a small amount of my portfolio. Now let's talk about one of the greatest asymmetric bets of the last 15 years. Can you guess what it is? Anybody? Bueller? No? Bitcoin. Yes, I said it. If you had put $100 into Bitcoin in 2011, you risk losing all of it. And most people think you would lose all of it, right? The asset was volatile, experimental, and not widely understood. But there were people that did understand it, right? And at one point, that $100 would have turned into over $60 million. Now, obviously, this is a rare case and only happens possibly once in a lifetime. And it is even more rare to have found this investment and hold on to it for that amount of time. I mean, just imagine $100 doubling to 200, then to 5, then to 1,000, then you're sitting on a portfolio of $10,000. Well, it is hard not to sell. But again, goes back to conviction. If you have conviction, never sell. Cut your losers, increase your winners. But the point is that you didn't need to be all in. A tiny allocation, right, 1% or less, could have changed your financial life. And if you ask me, that is the ultimate asymmetric trade. Lose 100. If you lose, did I have something in that investment? I don't know. But then you wake up one day and your portfolio is $60 million. Imagine that. Now, you don't need to be right all the time with this strategy. You don't need to find winners every year. You just need to find a handful of high payoff bets where the downside is capped and the upside is huge. And if you find a few of those, you can certainly quite easily beat the market. Now, this third strategy is probably the most psychologically uncomfortable, but also the most essential if you want to outperform the average investor. And that is you have to be willing to go against the crowd. This is what we call contrarian thinking. Buying when others are scared and selling when others are euphoric. Now, this sounds simple, but it's actually incredibly hard in practice. Let's start with fear. When the market crashes or when a single company is hit with some bad news, most people panic. They rush to sell. They don't even think about the long-term value of what they own, going back to the Meta example that I gave previously. And you can see proof in this in the stock price continuing to go down and down and down. Now, contrarians see the opportunity here. They know that fear creates mispricing. This is very important. Great businesses get sold off along with the bad ones a lot of the times, right? So again, thinking back to the pandemic, the entire market crashed 30% in just 1 month. This was, of course, the moment to buy, as I stated with my Leaps option example. As prices were dropping out of fear, you had companies go down 60, 70, 80%. And the reason that they kept dropping is because people kept selling them even at their lows. It's crazy when you think about it. Now, on the flip side of fear is greed. When a stock is going parabolic, you see it all over social media, the bragging, the easy money. When all of that is happening, people are piling in the money into that particular investment. This is when you should be cautious. Now, you know that, but do we do it? Kind of hard. Contrarians take profit when others are blinded by hype. Now, of course, we all remember GameStop and AMC during the meme stock frenzy, right? Retail investors were chasing them to insane valuations, and some people made money, sure, but most of the people just got in too late and held for too long. The contrarian move wasn't to buy in at the mania phase, it was to recognize that the fundamentals didn't justify the price at that time, or rather to find the company before the mania like Michael Burry did, because by the time the mania had hit, it was probably too late. Now, here is a mindset trap that many investors fall into. Apple is already worth $3 trillion. How much higher can it go? Now, what people don't remember is everyone was saying the same thing about Apple when it first hit $1 trillion. And before that, when it hit 100 billion or even 1 billion. I mean, there were companies that just hit the $1 billion mark back in the day. And people were saying, well, how much higher can it go? It's already valued at $1 billion. That's billion with a B. Then we get trillions with the T, so on and so forth. Things will continue to grow as long as the company grows. Just because a company is big doesn't mean it can't grow. If the market cap expands along with earnings and the business keeps innovating, the upside is still real, and that market cap expansion would make sense with the company's fundamentals. Now, being a contrarian often means ignoring these arbitrary psychological ceilings and focusing in on those fundamentals. Now, here's something else that feels totally wrong when you think about it. Buying a stock at its all-time high. Now, most people think that that's the worst time to buy, right? Because it feels like a missed opportunity. But in reality, many of the best performing stocks spent a lot of time making new all-time highs. Amazon, Apple, Nvidia hit dozens, sometimes hundreds of all-time highs on their way to delivering 10x or 100x returns. So if a stock has a 10x or 20x potential, then buying at those all-time highs ultimately means you are still buying at relatively low prices compared to its potential. Now, another key contrarian habit is letting your winners run and cutting your losers fast. See, most investors sell their winners too soon. They get nervous after a 20% gain and they cash out. But at the same time, they hang on to their losers hoping that they'll bounce back. Sound familiar? It's probably you. It definitely was me for the longest period of time. Now, I'm not talking about when everything is hyped up and everyone and their mother and their taxi driver are buying into the bubble. I am talking about your personal, high conviction, highly concentrated, asymmetric investment. It's a mouthful, but it works. If it is doing well, you need to give it time to fully deliver profits. So the formula is simple. Add to your winners, cut losers early. And cutting losers early is a big part of that. Remember what Tudor Jones said, you always want to play defense. Cut those losers out right away and add to those winners. Now, this is hard, right? Because it feels counterintuitive, but this is how you let your big ideas grow and avoid letting your losers drag down your performance. Now, contrarian investing isn't about just, being a rebel for the sake of it. It is about recognizing when the crowd is wrong and having the courage to act differently. In moments of fear, you stay calm. In times of greed, you stay grounded. And in a world of chasing short-term noise, you stay focused on the long-term game. Now, we started this video with a very simple idea that most people don't beat the market. And for most people, that's okay. Index funds, they work. But for the people who want a little bit more, maybe it's you, hopefully I've shown you a few paths in this video to beat the market. Sign up to my newsletter. Go ahead, check out my other videos on this channel on investing. Thank you all so much, and we will see you in the next video.